There are three big forces that have been at work, and I think you have to understand those. First is the debt money thing. How much debt and money, and what are the repercussions? How does that pass through the economy? What does that mean for markets, inflation, and so on? We're in a different era now. Zero interest rates, produce a lot of debt and monetize it. Second influence, the conflict, internal conflict over wealth, left-right conflict. That conflict. And then the third is the rising of a great power in the form of China challenging an existing great power and challenging the existing world order. Those three things are coming together at the same time as then we have a pandemic. So I think each one of those is a cycle. What's happening now has not happened before in our lifetimes, but has happened in the 1930 to 45 period. I went back and studied it over 500 years. And so it's that context. There's not enough money to go around, right? We're spending a lot more than we're earning. And we have to do that partially because of this social redistribution, that necessity, and they can't take it all from taxes. And what that means is the printing of money. So it's the mechanics of that. So what you do is you get more money. And so that devalues the value of money. In other words, cash is trash. This is guaranteed. You are not going to have an interest rate that's going to compensate you anywhere for inflation. So you have to look at the cost of the money, right? And so that interest rate, whether it's the bond rate or whether it's the cash rate, certainly, you're not going to get that. And so we have this wonderful sugar high, which is to distribute the checks and so on. But that means everything else goes up in relationship to cash because it's better to borrow cash. That's just mechanics. So we have that dynamic underway. So we produce inflation. But what you do know is that interest rates must be below inflation rates and must be below the nominal growth rate in order to deal with all of that debt in order to finance it. And that depreciates the value of cash and money. So you have to invest it elsewhere. That's the dynamic, right? On the margin, so if we look at the expected return of equities, let's say U.S. equities and so on, and you do the projections of present value of discounted cash flows type of thing, you probably can have somewhere in the vicinity of 3.5 or 4% return, and you probably can get, so return relative to the return of cash, it's a better deal. But as equity prices go up, those excess returns go down. That's what produces more of a bubble, in other words, the lower returns there. And as that shrinks, and then if you should have rates to rise, that cushion narrows. And as that cushion narrows, you come into more and more danger zones. So that's what we're seeing happening.
Do you believe we're in an inflationary environment? And I say that because that seems to be the prevailing view right now. However, we talked to Kathy Wood on Monday. She said, you know what, actually next 5 years, deflationary because of technology.
Well, those are the pros and cons, right? So we're in an era where there's much greater inventiveness, and that's going to produce productivity if it's managed well in this politically challenging environment. But if it is converted into productivity, that is a deflationary force. But we're simultaneously in this world in which nobody is really going to get paid for those assets. Okay, so you have to have the debt monetization. There's nothing that you can increase in supply quicker than money and money and credit. So let's look at it this way. There's a big increase in the value of financial assets. So think about yourself, each individual, and say how much of your net worth is in financial assets versus actual things, your house, your other things, your equity. And a lot of that money, there's too much of that money in financial assets that will never be able to get paid, because if you calculate how much is it in financial assets, and a financial asset is only a claim to buy goods and services, otherwise it's worthless, there's an enormous amount of that. How is that going to be dealt with? It has to be dealt with the printing of money. So you have those two forces. I think the greater force is the force of those financial assets that the world together will never be able to convert into goods and services because there's just too much of it. First, no, cash is trash. So don't keep it in cash, right? Second, the most important thing I think that an individual investor or any investor could do is know how to diversify well, because all those asset classes will outperform cash. And so if you, but also risk, when you can diversify well, and when I mean diversify across countries, currencies, asset classes, and so on, so that you have that balance. Then you take your tactical moves from there. But the most important thing, I think, is to know how to diversify well. I think most people are not doing that. I think most people think, okay, it's the stock market. And the stock market, I think, is relatively attractive in relationship to the alternatives. But that dynamic is going to start to change as monetary policy gets tighter and so on and so forth. So diversify well in those various areas. The country, the currency, the asset class. Bitcoin is a possibility, is that a merit? I have a certain amount of money in Bitcoin. It's a small percentage of that which I have in gold, which is a relatively small percentage of what I have in my other asset classes and so on. And I think that that has the merit. It's an amazing accomplishment to have brought it from where that programming occurred to where it is in the test of time. On the other hand, if it's successful, it's going to not be, the governments don't want to have it successful. You have El Salvador taking on, and you have India and China getting rid of it, and you have the United States talking about how to regulate it, and it could still be controlled. So that's what it looks like. If you're El Salvador and you talk about your alternative monies, you know, it's a different thing. Well, we have large wealth and opportunity gaps. You know, a couple of years ago, I wrote a piece which was called Why and How Capitalism Needs to be Reformed, because besides not being fair, it is not achieving the goal of being able to have broad-based opportunity, because capitalism intrinsically creates prosperity, but it creates it in a different way for different people. And that tends to be self-perpetuating, because those who earn the money then take care of their kids and they have better education and so on. And if you look at the bigger cycle, when you get up and rich and then you get into some problems, you have wealth gaps and the whole thing gets challenged. And that's the cycle that we're in. And so the question is how do you make productivity continue to increase rather than just redistribution? And so that's where we are politically. We have that conflict. We see the left-right conflict. We see it play out now in the tax bills and so on. We're going to see it in the 2022 elections. You're going to see it in the and that conflict itself is the ingredients of some form of civil war, conflict. It doesn't lend itself, you know, a war, it doesn't have to be killing each other. Okay, well, I don't mean it that way. I mean, but sometimes when it gets out of control, it does lead to that. It's a good thing that we read history and see how it is left in the past, how moderation has gone to extremism. It's something we should be aware of. But it is, we certainly have kind of a war developing between the various factions, the states, and so on, and how that'll be resolved. Like in the 2022 elections, there's still the question, there's talk of systematically challenging those elections. And if there's a systematic challenge, that's a challenge to democracy.